All right. Hey, guys. Downtown Josh Brown back with Michael Batnick for the first time in 3 weeks. I feel like we were seeing other people for a while. You had Nick Majuli on the show, and I had Ben Carlson on the show, but now we're reunited. How does it feel? Feel so good? All right. Batnick's rocking the Knicks sweatshirt. Not embarrassing. You can go out on the street with that these days, right?
It's been a while.
Yes? All right.
You know, it's the first time I've been excited to watch the Knicks since Porzingis' rookie season.
This is my favorite.
It's been a while.
This is my favorite, like, Knicks starting five since, or just the whole team, 20 years. 2001, I think, or 2000 or 2001 was the last time I was like, we got a squad. So pretty amped up. All right, we have what I believe to be some of the most important topics on Wall Street this week to discuss. We love this game. We love when you play along with us in the comments. We're going to get into everything happening on the street right now. Stick around. Let's see what's going on. All right. So first things first, the big story over the last week is interest rates. I actually don't think it's a gigantic story just yet, but it's moved trillions of dollars.
You're being that guy?
Well, I think it matters. I just don't think it's like... Why, you think it's Titanic?
Yeah, it's big.
It's a big... All right, so you'll tell me why. Let me read you this from Bank of America Merrill Lynch. Shout to Savita. Shout to all my some of my favorite economists and quants. The longstanding bullish mantra for stocks has been there is no alternative, or TINA, especially for income investors, given that the S&P 500 dividend yield has been within spitting distance of bond yields for 104 of the last 120 months. Today, over 60% of S&P 500 stocks pay a dividend yield above the 10-year. Our rate strategist forecast for the 10-year yield of 1.75% renders TINA less compelling. All right, so do we really believe that treasuries are super competitive with stocks at a 1.4% 10-year? I don't.
Neither do I.
Okay. They're making the case that 1.75% is where things do start to get a little bit competitive. They're saying that only 40% of S&P 500 stocks would have a yield above the 10-year if we got to that level. I think that's probably the top.
Are we boiling it down to, is it really that simple that people are only comparing the dividend yield on a stock versus interest rates? I think interest rates are super important, but it's not that simple. What I thought was interesting from that report was rising rates aren't necessarily bad for stock, especially if rates are rising because the economy is stronger. So they said that going back to 1954, stocks have had positive returns in 13 of the last 15 rate rising cycles. Now that's obviously, the index. Within that, it hits others, it hits stocks differently. But here's where I think it can matter. If enough people thinks it matters, that people start to get ahead of this, and let's say growth stocks pull back and rates do rise, it might not have to be causal, but if enough people believe it to be so, and we hear that over and over and over, that it could be a self-fulfilling prophecy. I think that's where it can matter.
So I have two things on this.
By the way, just buttoning that thought up. To me, that story is more important than like a higher discount rate, which pulls earnings 10 years out into the future, make them less valuable today. Like, I don't know that that intuitively that makes sense, but I don't know that investors are really so spreadsheet oriented. All right, your thoughts.
Well, so a couple of things. I think the cap is at 2% anyway on the 10-year in the current environment, just because you think about trillions of dollars sitting on the books at insurance companies, sovereign wealth funds. They're not going to sell stocks to buy treasuries. They're going to sell cash. Like, you think about how much money is yielding nothing. I think races in to buy a 10-year treasury at 1.75, 1.8, 1.9. They need the income, and they're not getting it where they are.
My favorite quote from last week comes from this guy, Glenn Capello. He's a managing director at Mishler Financial. He said, when the Fed's committed to keeping rates at or near zero, twos are probably cheap at 10 basis points.
Well,
it's a little crazy. It's a little crazy that you have to buy them at that yield, but that's your choice. So to your point, if rates get up to 1.8, 1.9, 2,
there's an ocean of cash to buy those. Yeah. There's an ocean of cash to buy those auctions.
I think you're probably right.
Yeah, and then the last thing, very quickly, I think what B of A is saying, and this is what most people are saying, this is consensus. It's not that stocks are threatened by a 2% or a 1.75% yield on the 10-year. It's different stocks will work in that environment than the stocks that worked at 50 basis points, which is where the 10-year was trading in August. So
that I agree with.
So they're saying it's different sectors. It's not growth tech.
So they showed like dividend yielders versus dividend growers. Like I thought that was super interesting. They did a lot of good work there.
Right. So if you're looking for dividend growers that have inflation protection built in, meaning they have the ability to pass on rising prices to their customers, so REITs come to mind, you should be fine. Like a 2%, I understand the move was fast. I don't think it changes the idea that stocks in a growing economy with growing earnings should be okay. All right, where are we going next?
We're sticking with rates.
Okay. You do this all day. I have more.
So Sarah Ponczak did this great chart that shows, remember last year, it was in the beginning of the recovery last year, it was all about stocks with strong balance sheets.
Yes.
Which made a lot of sense. If you can survive and get to the other
fortress
side of the pandemic,
balance sheet.
Right,
no, fortress.
It made sense.
Yeah.
So stocks with strong balance sheets destroyed stocks with weak balance sheets. Now the exact opposite is happening, and I don't have the breakdown of the stocks that are here in this chart, but when I hear weak balance sheets, I think like value type names, cyclical names, Carnival Cruises of the world, like stocks that are reliant on outside funding, on debt.
Yeah.
So if higher interest rates are going to hit growth stocks, wouldn't these stocks be doubly sensitive to higher interest rates? And they just had their best run since 2009 relative to stocks with strong balance sheets. One caveat: this might just be nothing but mean reversion. So that could be part of it too.
Well, I don't think these stocks are trading based on the interest rate on their debt because I think they all refinanced. Like there was money for everybody. Carnival Cruise got money.
At double-digit interest rates.
No, they borrowed money from Saudi Arabia.
I think it was double-digit interest rates.
All right, but so what? A lot of it was convertible too. Who gives a shit?
No, not so what. The growth stocks are borrowing a lot cheaper. At least I'm using Google and Microsoft as an example.
I don't disagree. My point is these stocks aren't even trading on what prevailing interest rates are. They locked in whatever they locked in. They're trading on the fact that their businesses were closed and are on the cusp of reopening. We're going to have 10% nominal GDP growth in Q2. We're almost in Q2. We'll have 10% nominal GDP growth in Q3. We're lapping last spring and summer, and these industries they were literally closed. How many cruises left the port a year ago, last March, the last cruise? So I understand why this group of stocks, I don't think rates have anything to do with it. I think this is like what segment of the economy they operate in. I also think that there are maybe a lot of small cap banks in this chart. What do you think?
Yeah, I think so.
The fucking regional bank index is up 27% year to date. You know why? Because they're borrowing for free and they're lending at a higher rate than they've been able to since 2019. That spread is immense. You think about where they were 6 months ago when it looked like they might have been sitting on like millions of broken loans. They don't have any of those.
So a lot of these names, banks especially, are tracking the 210 spread. And I forget who did this chart. I'll try and find it.
As they should, because that's how they make money. But they also don't have the wave of defaults that everybody said was coming. And they might in the future. True. But so if they don't have a wave of defaults, then they're over-reserved. They'll drop those reserves to the bottom line and report booming earnings. And the net interest margin spread is rapidly growing. So they're winning like 3 different ways. And most of them started this year at 10 times earnings. So you were not paying up for what's about to happen with those banks. And that's why they're up almost 30% on the year.
Meanwhile, a lot of the mini taper tantrum, it's not taper tantrum, the yield tantrum was unwound. So
it only took 1 day. All right.
What else?
What are we going to do? Oh, Warren Buffett's letter. So
Who?
Every year. Yeah.
I saw you guys dissing on him. I saw you guys.
I didn't diss on him. I said I'm not sure that his letter is meaningful to non-Berkshire shareholders. Do you have an alternate take on that?
No.
That's all I said. I think it used to be really important.
No. Hold on. No, I disagree. It's not as okay. It's not nearly as important as it once was. It's not nearly as.
Fine. Who is it relevant to outside of people who own shares of Berkshire?
I'm not a Berkshire shareholder. I read the letter.
I read it too.
Think I'm the only one?
but you and I would read it either way because we're fans. I'm saying let's say you're an investor and you own lots of stocks, but you don't own Berkshire. Were there any takeaways in the letter? Is there anything that Buffett had to say that really has any meaning to the rest of your portfolio?
Well, that's up for debate. What I liked about the letter was
that's what we're doing here.
He didn't knock me on my ass, right? I mean, he's not going to do that anymore. We've read 100,000 words of his, probably more than that. But what I liked was, as always, just the way that he communicates, just such a simple thing that we always lose sight of on the day to day. And that was, my favorite quote was, in its brief 232 years of existence, however, there has been no incubator for unleashing human potential like America. Despite some severe interruptions, our country's economic progress has been breathtaking. And that's all I need from him. I just need him to reinforce the long-term optimism because, again, in the day-to-day, it's so easy to lose sight of that.
Yeah, he skipped a lot of the stuff that he usually dwells on, like the history of the insurance business and all that stuff. And he's just like, look, man, I wrote this.
Yeah, he said, skip to this page. I've done that a million times. How about him subtweeting Elon and that whole group?
Yeah, well, that was pretty right. Yeah. And then he spends a little bit of time on Burlington Northern, which is his biggest operating unit. He's super bullish on the energy side of Berkshire, which is all the utilities. And then he kind of mentions Apple. Apple is like one of his top 5 holdings. Imagine if he didn't buy Apple.
It's his second biggest asset. That's insane. I think they bought it in 2016 or 2018. I can't remember, but they bought it for their cost basis is $30 billion. It's 120.
Right. It's worth $120 billion. They're getting paid almost $800 million in dividends a year from Apple. And they have to sell it to keep it at a reasonable size. They actually trimmed it last quarter just to keep it in line. They own 5.5% of Apple. I don't know if that was Warren's idea or if it was.
No, I don't think so. No, come on.
I don't think so, but it's one of the greatest things he's ever done.
Last 2 years, Berkshire got destroyed by the S&P. 18% versus 2% last year. In 2019, it was 32% versus 11%. And one of the simplest reasons, in my opinion, is he wrote, Berkshire owns American-based property, plant, and equipment, the sort of assets that make up the business infrastructure of our country, with a gap valuation exceeding the amount owned by any other U.S. company. And who the hell wants capital-intensive businesses these days? That is so not in vogue.
So he's going to fly out to L.A. to be with Charlie for the May shareholders meeting rather than have it in Omaha. Nobody can come anyway. So last year he did it alone for the first time, and it was tough to watch. And this year Yahoo will film it, but he'll be with, I guess Charlie at 97 years old isn't getting on a flight to Omaha to sit in an empty auditorium.
Yeah, no disrespect. Obviously, we're big fans. I will not be tuning in.
Huge fans. I might watch it, or I might just watch like a highlights package. All right, let's keep it moving. What do you got?
What do I got? I wanted to talk to you about this idea that I'm struggling with. What if this doesn't end badly? And I'm thinking basically everyone thinks it will. Everyone thinks it will, and it's hard to think that it doesn't. But when I say everyone, who am I really talking about? Is that just anecdotal? Because I listened to Grantham the other day. And on the one hand, it feels like every time stocks fall a little, people lose their shit. So, for example, Carl Quintanilla tweeted something from JP Morgan pointed out that the VIX is now disconnected to underlying short-term S&P 500 realized volatility, indicating a bubble of fear and demand from investors looking to hedge or profit from a hypothetical market sell-off. Okay, pause. That might be the case. But can you really say there's a bubble of fear when everything suggests that there's a bubble of euphoria? It's like so I'm having trouble squaring these circles. What's going on? Help me out.
The VIX is not indicative of anything. It's just all it's doing is revealing an increase in trading of options, which we all know is being driven by a retail stock trading mania, and they've discovered options. I don't think there's as much. First of all, the VIX is a concurrent signal. It doesn't.
All right, forget about all this.
Throw that out.
Here's what I want your opinion on. Here's what I want your opinion on. What if this doesn't end badly? What if this environment continues with brief crashes here and there and shakeouts and everything? Of course. What if this continues for another 5 years?
Well, arguably it ended already, and we're in something new. You have a 30% bear market. You reset. So I don't think we're in a new secular bull market. You know my opinion. I said this in real time in May 2013. I said this is a new secular bull market until somebody proves otherwise, and they never have. We have not gotten below that level. That was where the S&P took out the '07 high and the 2000 high for that matter.
You're taking a victory. You're taking a 2013 victory lap. I think statute of limitations has run out on that.
No, I'm just saying I don't think the environment's changed. I think we're in the same bull market. It's a secular bull market. It's not different than the one that started in '82.
Can you see this lasting another 5 years?
Why can't it?
I'm going to hold you to that. Next topic.
Well, hold on. 82 to 2000, 1987 was right smack in the middle. It didn't end it. It was an event. So in hindsight, looking back on what we just experienced last March and April, does that look more like 1987 or does it look like 2008?
It looks like 2020.
Come on, seriously. If you had to say, what is this more akin to? It's an event.
Right.
It's an event.
The difference is that was a market event and this is a market and economic event. I mean, of course it's not the same.
Well, that's true. That event originated in the market and never spilled over into the real economy. Some people say Greenspan took rates, extremely low for the first time in that episode and prevented it from spilling into the real economy. I guess we did the same thing this time. So we had an economic disruption that very quickly has been papered over by this massive transformation into a new digital economy. It's unbelievable.
Here, let me put your feet to the fire.
Go.
Give me the odds that this ends badly, and I'll define that as
100%. It always ends badly.
Hold on. Let me lay the groundwork. When I say this ends badly, I don't mean like shit blows up, SPACs go away, NFTs, whatever. I mean like the overall market, the Russell 1000, the S&P, falls 40%, doesn't recover for 3 or 4 years. This ends badly. On the other hand, you have not that. So what would you say, 50-50, 60-40? How would you handicap that?
But you were asking me to say there was never a 30 or 40% drawdown again.
That's not what I'm saying. What I'm saying, this ends badly doesn't mean a 30% decline in recovery. I'm saying a 40% decline that doesn't recover for 3 or 4 years. This ends badly.
I can envision a scenario where the NASDAQ falls 40% and the S&P corrects 20% as interest rates rise. But that fall in the NASDAQ is a grind and takes place over 10 years. And it's just purely based on people losing enthusiasm for, the top 10 or 20 tech stocks.
To me, this ends badly.
Okay. Did you ever see Cocktail? I hope so.
No,
I'll hang
I
up
haven't.
if you haven't.
I haven't.
Okay.
Not an early TC guy.
I don't know all these movies you're watching, but
dude, Cocktail I think got like a 16 on Rotten Tomatoes.
Why don't you do me a favor and watch it? So there's a scene with it's maybe top 10 of that decade. There's a scene where Elizabeth Shue says, "I don't want this to end badly." It got a 7,
dude. It got a 7. Sorry, a 7.
Just trust me.
Go ahead.
She says, "I don't want this to end badly," meaning her relationship with TC, and he's like, "Everything ends badly. Otherwise, it wouldn't end." Whatever he says. So, of course, it's going to end badly, but badly for who? Not equally badly for everyone. I don't think what this market has done requires a wholesale global economic meltdown to put back in its place. I think we probably have some pockets where people get blown up. All right, let's keep moving. I wanted to get into WandaVision. I think it's the best show. The best new show to come on any of these streaming services, maybe in the last 2 years. I'm like incredibly blown away by every aspect of it. What did you think?
All right, I am blown away. I completely agree. And of course, episode 1, you're like, where is this going? This makes no sense. But I had faith.
Which I love about it.
I had faith that they know what they're doing. They were going to pull it together, and boy, did they ever. So on the one hand, I think it's brilliant. All of the different storylines that they've brought in. And by the way, Elizabeth Olsen deserves an award for this. I'm not even kidding. She's insanely good, right?
Do you know that she's the little sister of the Olsen twins?
Are you memeing me?
I swear on my life. I swear on my life.
Of course I knew that.
Oh, you did know that? Oh, I didn't know that.
She only looks exactly like them, and her last name is Olsen. But aside from that, no.
I'm an idiot, though. You have to remember that.
Remember in the office when you had your AirPods in and you were on your phone like this, talking to your phone?
Oh yeah, I was like this all the time. So you have to keep in mind what an idiot I am. She's an amazing actress.
So I like the show. Don't get me wrong. I enjoy watching it. But I think I'm more impressed with what they've done than I'm not my jaw is not on the ground as I'm watching it, if that makes sense. You know what I mean? I don't think it's the best viewing experience, but I'm totally blown away with it at the same time.
So I thought that the creativity of it and how unconventional it is,
right?
And how they
the commercials in the show.
Yeah. So let me ask you this question: if this wasn't streaming, let's say this was a show on ABC that just came on every Thursday night at 9, they could not have pulled this off because they don't have a captive audience that they know they can hook into a binge on a show that airs once a week. Do you understand what I mean by that? The only reason they could get away with the setup of those first 2 episodes is that it was on a streaming service and they were counting on most people just consecutively letting it play out.
Well,
so
also,
I think the medium is changing the bounds of how creative you could be to launch a show.
Well, also they have a built-in fan base. It's like Apple, right? Like they have like diehards. So people like me, who I saw the first episode and I was like, this doesn't, what? But I knew that that's not what the show was going to be about. I knew it wasn't just Dick Van Dyke, that they were going somewhere with it.
So I just think like thinking outside the box, you read like Marty Scorsese being like, this isn't artistry or whatever. What are you talking about? Yeah, when was the last time he did something?
Shut up, old man.
Like mind-bendingly.
Just kidding. But
he basically remakes the same movie every 5 years with De Niro, no matter how old he is in the title role.
That's not true.
All right, I'm sorry. Sorry, Scorsese stance. Anyway, I thought it was brilliant, and I can't wait to see where they take it.
Here's what I say: it could have gone horribly wrong, though. Like they pulled it off. It could have been so dilapidated if they didn't have the team or whoever's responsible for producing that, and it could have gone very poorly.
You know who's great? The woman from Saturday Night Live, Anna Gasteyer.
She's she's the stepbrothers for me.
All right. I thought they did something wildly creative and it worked, and I'm super pumped. All right, what do you got?
All right. How's this for a lead? California aerospace startup Archer Aviation has a multi-billion-dollar vision of flying people around town in autonomous electric helicopter-like vehicles. It doesn't have any revenue or a vehicle ready for passengers, but that hasn't slowed the 3-year-old company. Instead of toiling away in obscurity with a shoestring budget, the traditional way for startups to spend their formative years, Archer became part of the SPAC frenzy gripping Wall Street. This month, it announced an agreement to merge with a special purpose acquisition company, raising $1.1 billion. Why not? And gaining a valuation of $2.7 billion. So when you say like this ends badly, like maybe this is the space where investors just get their faces ripped off. There's this chart that we're going to throw up. Sam Rowe tweeted this morning. 175 SPACs have raised $56 billion in capital year to date. Just wow. But here's where I'm going to zig on this one. What if this does end badly for a lot of investors, but because there's so much access to capital that we end up getting like the next Amazon or something like that? A company is born that ordinarily wouldn't have access to money.
What if you can't get the next Amazon because so many companies have so much money to compete with that nobody emerges with enough dominance to become that?
You can't triple stamp a double stamp.
Well, I just did. So investors are so horny right now. Like they're just horny. Like they'll do anything. Investors will literally say yes to anything. They really don't even care. And they're even, when you talk to public stock market investors who are like binging on Mark Andreessen content and like jumping into Clubhouse and like pretending to be VCs.
I jumped on Clubhouse last night.
Did you? How'd it go?
Yeah, A16Z.
Okay.
They were talking
they're
about
great.
medicine.
By the way, they're great. But there are like regular investors who are mainlining that shit, just injecting it right into their veins. And they're even talking that way. They're like, I buy 12 SPACs and I expect 8 of them to be disappointments and 4 of them to triple. And I don't even know if that's a bad strategy. If you did that over the last year, you probably did better than the S&P.
Yeah, you kidding me?
Right. So like, who am I? Who am I to criticize a strategy that is working right now and maybe will continue to work for a long time? Also, what if we get fucking helicopter taxis out of this? Like, what if this company doesn't, quote, deserve to be worth $3 billion out of the gates, but it is, and they end up literally picking us up in choppers in 3 years? I'm not mad at that.
I'm pretty much celibate. I only went in on 2 SPACs.
I bought one.
Which
I didn't even tell you about this. I don't want this to move the stock price. So please, if you're listening to this, I'm not your financial advisor. Don't buy it. Gores Holdings VI, Gores Holdings 6. I don't care about Gores. I bought it because I like the underlying company.
This is Al or Tipper spec. Which one?
No, this guy Alex Gores is like the SPAC kingpin. Like he's like Chamath.
All right, who cares?
All right, I don't care. I bought it. It's a software company that I'm really interested in. All right. I just feel like the negative is that a lot of companies that maybe shouldn't have gotten funded to the degree they have gotten money. Who did that come from though? It came from people who want to invest. Mm-hmm. So I'm not mad about it. I don't know. I'll reserve my judgment. We'll see how many of these things turn into real companies, and we'll see how many don't. And
By the way, you saw this chart. Public listings by zero revenue companies valued at $1 billion or more just passed the dot-com bubble. That's pretty wild.
That makes me a little nervous. However, a lot of these companies, it's a pile of cash until the deal is announced, and then you have the option. You could say, I don't like this deal and sell it. Nobody's stopping you. So to me, it doesn't seem like anybody's getting hurt. Will people get hurt eventually? Again, it always ends badly. All right, let's do viewer topics. Duncan, come on in.
Hey guys. So I'm still recovering from your, discussing Scorsese like that, but today's first question comes from Herman in Queens, and he says, how come you guys never criticize the Fed or our monetary system? You almost seem like Fed apologists. And can you also just kind of explain what their point is? Like for people who aren't like finance pros?
Josh, you were way too easy on Janet Yellen for my liking.
Yeah,
please
really.
Eviscerate her now.
She was when she was in the Fed, I gave her a pass. Now she's in the Treasury. I don't know what that means to be a Fed apologist. The Fed probably just saved the world a year ago.
There you go again.
I know, but seriously. Before the Fed, so the biggest critics of the Fed, I think, are people who are just angry about the fact that speculators and hedge fund managers have made a ton of money, and a lot of people have been left out of that equation.
I get that, by the way. We all get that.
100%. I don't disagree. More and more of the wealth creation is taking place away from the factory, the plant, Main Street, and taking place in the investment markets. And people are angry about that. I also think the Fed's played a major role in creating some of the biggest booms and busts we've had over the last 30 years. I don't think it's undeniable the Fed's role in the housing crisis, for example. The other thing is that every time the Fed steps in to save the markets or save the economy, income inequality gets worse. Like this might be an exception, this last go round, because the Treasury was involved and there were direct payments. I don't know. But the stock market boom, just that recovery boom gets the rich richer every single time.
So they own the assets.
Yes, I don't have an issue with those critiques of the Fed. I would just point out, however, that you've got to have an awareness of what the economy and the markets were like pre-1913, and to realize that prior to the Fed, we had this guy behind me. I don't know if you could see that.
Christopher Wallace.
No, J. Pierpont Morgan. Oh. So he was acting in the role that the Fed acts now. So is that better? Do we want a bank, a private bank, doing what should be done systemically? I don't think so.
I think people are also mad about the money printed. They're hard money. They're hard money people.
Well, they also don't understand that the country is not the same thing as their house, and so they like get caught up in these like corny colloquialisms that you hear from people like Rand Paul. They're like, well, if you're borrowing more money than you're earning, it's not your house is not the Fed.
You're stealing from your grandchildren, Josh.
Right. You balancing a checking account is not an analog to central banking. One thing has nothing to do with the other. So, but I'm not a Fed apologist. I get the pros and cons. I think the pros outweigh the cons.
I'm a Fed apologist.
Until the Fed blows up the sun with a nuclear missile, I think I'm okay with there being a lender of last resort. All right, let's move along. Duncan, what else you got?
Okay, so John writes, I own the B&D ETF, bond ETF, only because I'm supposed to own bonds in a balanced portfolio. I'm pretty astute when it comes to how equities work, but bonds have always been a blind spot for me. When yields rise, the principal value of bonds goes down, right? With yields having nowhere to go but up, how on earth does a bond ETF ever go up?
Well, you want yields to go up because as a fixed income investor, the only way that your fixed income goes up is if rates go up. And yes, if rates go up in a steadily order, your principal will erode a little bit in the short term. So you're going to take one step back to take two steps forward. We need rates to go up. If they don't, then we are destined for 1.5% or wherever it is, nominal returns, and nobody wants that.
Don't you think that's hard, though, for people to wrap their head around, that they actually want their bond position to be negative in the short term so that it's positive in the longer term?
Yeah, I think the misconception is that rising rates are going to put a missile-sized hole in your bond portfolio. Now, if you're all the way out on the duration side of things with long-term bonds, then yes, that is absolutely the case.
What's the duration of BND right now?
It's long. It's the longest it's been basically ever. So, but it's not like we're not talking TLT style destruction. So, I don't know what the pullback was recently. Probably just a few percent. But I always say that a bad year in the bond market is a bad afternoon in the stock market. Like the two are not even in the same universe. So don't worry about your bonds. It sucks that interest rates are where they are. But on the flip side, look what stocks are doing. So
didn't Ben do a thing about like you can count the number of years with negative returns for the bond market worse than 3% on one hand?
From 1946 to 1981, I believe, or something like that. The 10-year went from 2% to 15%. And the worst nominal loss for bonds was negative 5% for the 10-year.
In one calendar year.
In one calendar year. Now, don't misunderstand. Bond returns were ravaged by inflation. So real returns, you had like a 46% drawdown that lasted like 25 years. But it's not the nominal losses that get you. It's the real losses. All right. I think that's it.
I think, I think we covered that. All right, so we want to tell you guys to make sure to keep those topics coming. We have a lot of fun reading them and getting to as many of them as we can. So you're going to send an email to askthecompoundshow@gmail.com. Send us what topics you think Michael and I should cover. Thanks so much for tuning in. I know we went a little bit long today, but there's a lot to catch up on, and Mike and I missed each other. Tune back in every Tuesday, roughly 5:30 p.m. for the latest episode of What Are Your Thoughts? And we'll see you next week.